As 922 is some reinforcement for you on that gross profit percentage calculations. This problem also shows that if you have a situation where you have part of your records missing, you can still come up with some of your numbers. Okay? So in this case, 922, we have Stucco Company that has waterlogged records, right? And so he's got some amounts missing. He doesn't know what his ending inventory is, so it's gone bad on him. Okay, but he knows what his sales are, and he knows what his beginning inventory was because he has that recorded, right? And he knows what his purchases are. So his goods available for sale were 669,340. Okay, and so what they're asking you basically is, look, well, I run a gross profit of 45%. So can I come up with my ending inventory? Okay, so based on what my gross profit ratio has been over time. Okay, so what we're doing is I've kind of inserted these calculation results up here instead of question marks, for the auditor, for the author, excuse me, and stuff. But um, 287, 280, guys, is 45% of this sales up here. And then this cost of goods sold amount is 55% of sales. Okay? And then we just kind of back into ending inventory. So it gives you a little bit of calculation. Understand too that this is the periodic inventory system, and this presentation on the income statement for cost of goods sold would be directly associated with someone who was counting their inventories not perpetually as they sell them, but they're counting them at the end of a period, like the end of a month or something. And then they take inventory and they determine what their cost of goods sold is. So they have a beginning that they've got recorded, and then of course, they know what they purchased. But in this case, they didn't know what their ending inventory was, but they were able to calculate it. So anyway, some reinforcement to go over this problem and connect. You'll find them to be real straightforward. We're going to get to 924 now. This is going to be our cash flow discussion. I want you to know that doing a cash flow statement is not as hard, especially in this textbook and with this author, and the way he presents the information is very logical. I really appreciate his way. Okay, but in 924, he basically tells you, he gives you some information. It's kind of listed in a subset there, right? And it's got information related to net income and depreciation and purchase of equipment and some cash balance. And so what I'm going to do is I'm going to put all these in the right place, and that is that they're going to go. The cash balance is going to go at the bottom of the statement, and the cash flows are going to be calculated either for operating or for investing or for financing. So first, let's take a look at what the solution looks like for cash flows from operating activities. Notice we take net income first, right? This is an indirect method of doing statement of cash flows. Many companies use this. About 90% of the companies use this kind of a formatting. I want you to know that in, depreciation, is always deducted from net income in the operating section. And then what we need to do is we need to either add or subtract these changes in current assets. Okay. So in this case, they just give us accounts receivable, they give us inventory, and they give us accounts payable. They give us these three. And what I want you to know is that this is calculated in a way that if we have, guys, an increase in receivables, that means we're not getting money we need to get. So it has a negative effect on cash flows. If we have a decrease in inventory, that means we didn't have to buy inventory that we've sold, right? Because there was a decrease in the amount of inventory over a period of time, right? So that means it has a positive effect on our cash flow because we didn't have to purchase, if you will. Now, what about a payable increase? Well, if we have a payable increase, well, that means that we're not paying it. So it's a positive effect on our cash flows when we don't pay something. So if we take these and we either subtract them or we add them to our net income after we take out depreciation, after we add back depreciation, excuse me, then we come up with a net cash provided by operations. And I want you to realize this too. If you'll go here, I've got this set up here in a memorization mode. I put this and inserted this in here. If current assets, guys, increase in a cash flow problem that you may have, then cash flows are going to decrease. All right, so there's an inverse relationship between current assets and cash flows, right? Current assets go up, cash flows go down. If current assets decrease, then cash flows will go up. So it is still an inverse relationship, you see. And then current assets, same way. If there's an increase, then cash flows, then there's a direct relationship, so cash flows go up. Increase means increase, right, for liabilities. But then if you have a liability that decreases, then it's going to also decrease cash flows. So that's a direct relationship, okay? And if you learn that, if you just kind of memorize it, then you can work almost any statement of cash flows problem that's in almost any accounting textbook. But you come up with the cash flows for operating activities by taking net income, and remember, adding, I misspoke a minute ago, not subtracting, depreciation. Because remember, we're adding back depreciation because it has no effect on cash flow. So they add it back, okay? In order to get, we took it away, remember, to get net income. So we're just adding it back because it has nothing to do with cash flows. And then we go ahead in these increases and decreases in either current assets or current liabilities. And then you'll notice here now when we get to cash flows, and we got some purchase of equipment and sale of a building. When we purchased equipment, cash went out. When we got the sale of the building, cash came in. So when it does, it tells us here what to do. It's a direct relationship. Same thing with common stock. You issue common stock, you're going to get money. That means cash flow goes up. If you pay dividends, that means you're paying out money. That means cash flow goes down. So both investing activities and financing activities, both of them are calculated in a direct relationship to the financing activities that are going on or the investing activities that are going on. So there is no inverse relationship except for current assets. So all you have to do is just kind of memorize that. Right? But what I want to do is I want to show you how this works here. If you take this net cash flow from operating activities and you subtract out that negative cash flow that's investing and the negative cash flow that is financing, then you get a decrease of 40, right? And I think this is in the millions here up here, right? Millions, right? We get a decrease in 40 million as far as our cash flow is concerned. Well, I want you to look at this. Wow. Look at the cash balance. 60, now it's 20. Well, this is then reflective of our cash account. Our cash account should reflect a decrease of $40 because what we're doing is we're taking all of our accruals, converting them to cash, and then we're taking all of our cash flows and documenting them on a statement. That's all we're simply doing with a cash flow statement. So this is not something that students usually, once I explain it like this, have too much of a problem with, as long as they memorize current assets, inverse relationship, current liabilities, direct relationship, and they understand what that is, then they can work any one of these problems. Not a hard schedule at all. But I want you to make sure that when you study cash flows in the chapters, that you understand this and how it works, because they're going to ask you questions about investing. They're going to ask you what exactly cash flow is investing, right? And you have to know that it is property, plant, and equipment that's being either disposed of or purchased, right? And that financing activities are those activities that you use in order to gain capital. In other words, to be able to then function or buy assets or employ more people. Whatever you need financially comes from the financing activities that's over and beyond the operating of the business. So all of this is kind of documented in the statement of cash flows. It's really interesting how we just adhere so much in accounting, right, to accruals, guys. I mean, accruals is everything in accounting. Boy, if we sold it, and by God, even if we didn't get the money, we're going to record it, right? And if we incurred that expense, we're going to record it. But ultimately, in the end, we go accruals, but we know that investors need to know also all about whether or not we have a positive cash flow or not, or if we do have a negative cash flow, that is explained appropriately on a cash flow statement. So that's what cash flow statements are about, is taking the accruals and turning them into the cash basis. So we now have a view of what everything, all of this, does to cash and why it did it to cash. So it tells you that on the cash flow statement. Really, really good tool, right? For getting back to the basics and getting back to, there's a lot of investors, guys, that just look at the cash flows and see how well they are flowing, right? And then they're looking at the balance sheet and they're getting a statement in time and what does cash flow look like? And they do their own little calculations for determining whether or not this company is viable, and they use these. And so you need to just be aware of that. And generally, what's happening with a cash flow statement. So we've given you a little taste of this, guys, as an MBA student, just so you'll understand the different financial statements and the importance of them and what they're for, what they're used for.